Hello and welcome back to another episode of Darwin Investors. Man, what happened last week? On Thursday at the end of business, I was up for the year, and by the end of the day on Friday, I was down 5.6% for the year. It's like some big angry bear came in and destroyed my entire portfolio. But I'm not too worried. I run a very conservative portfolio. We're talking about Microsoft, Amazon, Google, Lowe's, JP Morgan, Nvidia, AMD. I have one wild card in Polestar, but it's a small position. And so we're going to talk about what happened last week and why that might have happened and what to expect this week going forward. But before we get into all that, I'll just show you how I did last week on my options trades. So last week was the week of the 22nd of August through the 28th of August. And you can see that last week I ended up making $1,134. My Macy's position was very uneventful. I ended up getting out of that with a gain of like $10. I made $64 on Macy's, but then I lost $54 or $52 or so on covered calls. So it ended up being net about $12. I was in and out of Advanced Auto Parts. They crashed after earnings, but it's a very good company with a very nice dividend yield that's above that of the 10 year. So it's something that I really believe in. Plus, they grow really nice and they do have kind of a really nice moat. And I don't want to call it a monopoly, but there aren't a lot of auto parts dealers out there. We've got Advanced, O'Reilly's, AutoZone, and maybe Napa, but there aren't too many. So these guys work in a pretty small market, and they deal to the DIYer as well as the professional client as well, people that own their professional shops and making a living doing that. So I like them. And so I was in and out of Advance quite a bit. And then I sold a put on Advance. I sold two puts on Toll Brothers, sold one covered call on Lowe's, sold two puts on Applied Materials, one put on Dollar General, one put on Snowflake. Looks like a covered call on AMD, another covered call on Applied Materials, and a covered call on Nvidia. And that was last week. It ended up netting me 1134. So far for the month, I would be up on my options. Let's just see here. I'm up 22.98 this month on options, and for the year, I am up $12,357. I'm up for the year on options. Plus, I put in money every 2 weeks. It's the way that I just invest. I don't put in a ton of money every 2 weeks, but I put a little bit of money every 2 weeks, and then the options, and it has me, well, up until Thursday, I was up for the year, but now I'm well down. So what happened last week? Well, before we get into all that, I just want to quickly just review the bond market. And so what we're going to look at in particular is the 2-year bond and the 10-year treasury yield. So the 2-year treasury yield at 3.38%, that would be the average interest rate over the next 2 years. So someone predicts that over the next 2 years, our average interest rate is going to be 3.38%. We're currently sitting at about 2.25 to 2.5. So they're expecting that in the next 2 years, that should go up about another 100 basis points or 1%. But then that is expected to soften over the next 10 years because 10 years out, we're only expecting a 3% return. And so you have to ask yourself, do you think you can buy equities that will return better than 3%? If the answer to that question is yes, then you're going to be long-term bullish. Now, you may not think you can return better than 3.38% over the next 2 years because you think in the next 2 years the market has continued to be soft. Like in the last year here, if you just had a 2-year bond returning 3.38%, most of us would say that's probably better than our portfolio is doing right now. And so the stock market is saying that we're short-term bearish, but long-term bullish. And that's important because the equity market follows the bond market very closely. It's the bond market's the dog and the equity market is the tail. And this is important when we get into Fed Chair Powell's speech to understand this. And then we'll take a look at what the bond market did on Friday and then what that tells us for the equity market going forward. I hope you caught all that because this is very important. Okay, so what was the equity market pricing in? Well, the Purchasing Managers Index is a measure of the prevailing direction of economic trends in manufacturing. And on the 23rd of August, S&P Global Flash US Composite PMI reflected weak client demand. And you can see here from the chart, it's the first time it dipped below zero since the pandemic, and only the second time since the great financial crisis. This is showing weak client demand. This is what the Fed wants to have happen. On the 23rd of August, last Tuesday, this was considered good news for the equity markets. So what we're showing is that material shortages, delivery delays, hikes in interest rates, and strong inflationary pressures all serve to dampen customer demand. According to panelists, August data signaled a renewed contraction in overall sales as manufacturers and service providers struggled with subdued demand conditions. Though modest, the drop in new orders was the sharpest in over 2 years. New sales were weighed down by weak domestic and foreign client demand as new export orders fell further and at a solid pace. This is right in line with what the Fed was hoping to do. And it's also pretty much in line with what we're finding out from the retail companies that reported here recently. We're showing a softening in the demand of durable goods, be it consumer electronics or apparel. The used car market is showing softening demand. The housing market is going back to the way it used to be. You list something, maybe you don't get what you're asking. There's no like 20 people coming in doing a bidding war. It's going back to the way things were, which isn't to say bad. It's just not turbocharged the way it's been the last couple of years. So this was considered good by the equity market because it means that Fed Chair Powell might not have to hike up interest rates that much further. And then on Friday morning, we got an updated PCE print, and that showed that the Fed's preferred inflation measure showed price pressures eased in July, and that came out about 8:45 in the morning. And Fed Chair Powell talked from Jackson Hole over there about 10 o'clock in the morning. So this came out ahead of time. And what this showed was the personal consumption expenditures price, PCE, showed a year-over-year rise of 6.3% in July, which was down from 6.8% in June. The reading actually fell 0.1% month over month. And the PCE is the Fed's preferred measure of inflation because it takes away the volatility of food and energy. It's just the way that they like to look at it. And so when they saw this core PCE, they said the core PCE index, which excludes volatile food and energy prices, had a 4.6% rise year over year and a gain of 0.1% month over month, coming in softer than forecasts on both accounts. And that came on the back of the July CPI report, which showed slower than expected rises in prices year over year and 0% inflation on a monthly basis. So prior to the Jackson Hole speech, everything looked like it was going according to plan. We had softening demand in durable goods. We had a PMI index that's showing weakening demand. We have a PCE measure that shows softening inflation. So it's time for us to party, right? No, so Fed Chair Powell, he wants to come out here and throw a wet blanket on top of this party. So he has to give this very hawkish speech to show that, just to keep inflation from spinning out of control again. Is he rooting against us? No, he's not. He's not trying to crush the market. It's just that right now the Fed has this dual mandate of employment and inflation. And right now, this mandate's very lopsided in favor of inflation because we're sitting at full employment. And what people believe is that should this thing get more even instead of like lopsided, like unemployment starts creeping really high and inflation's high, they're going to have to like thread the needle a little bit and not going to just send us straight into a recession. This is the prevailing belief. And let's break it down, and then I'll show you where I believe the stock market actually crashed and why. And it's not where you might think. This was the part of the speech that got all the headlines that said, restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. We're already seeing supply and demand come into better balance. That was reflected in the PMI read that came out last Tuesday. Reducing inflation is likely to require a sustained period of below trend growth. Again, we're already seeing this in our earnings reports as these companies are showing pretty soft guides. Moreover, there will very likely be some softening of labor market conditions. Again, we're already seeing that in kind of slow motion as a lot of these companies project either weakening hiring or cutting jobs altogether. We're already seeing these things. So while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain. And what people kind of focus on is the Fed may require using our tools forcefully to bring pain. And while this got a lot of the headlines and the attention of people on television and that sort of thing, I don't believe this is what drove the stock market down on Friday, because again, these are things that we all know, and these are things that we see that are already kind of coming around for us. What I believe took the market down was this. We are moving our policy stance purposely to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. Okay, so in the long run, we're going to be about where we are right now. We're currently sitting about 2.25 to 2.5. This is not bad so far. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to stop or pause, meaning that we're there right now, but there's no reason for us to stop or pause raising these interest rates higher. And then restoring price stability will likely require maintaining a restrictive policy stance for some time. So now they're saying we are not going to pivot. We're going to continue to raise, and we have no plan of bringing the interest rates back down. The historical record cautions strongly against prematurely loosening policy. The committee's participants' most recent individual projections for the June SEP shows the median federal funds rate running slightly below 4% through the end of 2023. And this is what broke the market on Friday, because we were expecting a pivot in the middle of 2023, and now they're saying that we're not going to get a pivot in 2023. And so what this did was it caused the bond market to spike. So when we look at the 2-year here, that what happened last Friday, and we look at the 1-day, when they saw that we were going to raise to 4% and leave it there through 2023, and there wasn't going to be some sort of pivot, remember what we've said, that this 2-year yield projects what they believe is going to be the average bond yield over the next 2 years, causing this to spike. And also remember what we said, that the equity market closely follows the bond market. So the bond market just spiked up in a straight line, and the equity market says, hey, why are you guys doing this? We knew all of this data already, and the data is coming in softer. The party's still going on. And the bond market saying, no, panic. The party is over. You guys need to sell. And so but they still took a little bit of time, and they said, no, we don't really need to sell. We're going to be okay. But by the end of the day, they said, all right, sell. But by the end of the day, look what the 2-year did. They said, you know what, Fed, we don't really believe you. And then that was the same thing that happened here with the 10-year yield. We can see that it finished the day at 3.03%. When we look at the 10-year on last Friday, we can see it reacted very similar to the 2-year in that it spiked straight up. It's like, oh no, they're going to hike it up to 4%. They're not coming back down for some time. And then by the end of the day, it was flat. It finished, that's as close to flat as you're basically going to get, 0.006. The 10-year yield said, okay, again, we don't believe you. In the meantime, the equity market started coming down and going further and further and further down. But I suspect that at the beginning of next week, the equity market's going to turn around and say, we don't believe you either. Now, one thing that is coming out next week is going to be another payroll report. Um, the payroll report last time showed it was a lot stronger than what was expected. The payroll report is going to come out on the 2nd of September at 8:30 a.m. They're looking for about 297,000 jobs to be added. But if this comes in weaker than expected, we can expect that risk assets are going to get a little bit of a tailwind, maybe some unprofitable tech companies or what have you, because they're going to expect that the Fed is probably going to slow their roll a little bit, maybe still hike and maybe not bring things down, but not like hike to levels that they hadn't already priced into the S&P 500. We also see that this average hourly earnings last time was at 5.2%. Remember, we're trying to control wages. But when I look historically at 5.2%, it's really not that bad. So you look at 5.2%, and this is over the last 5 years, puts us pretty much in the normal range. If you look over 10 years, or this was 10 years, if you look over the last 25 years, you can see that 5.2% isn't that high. And if we max it out, we can see that 5.2% again is somewhere in the middle. The only time that wages really spike is during inflationary times. And actually the last 10 years have been relatively low relative to the rest of this chart. So 5.2% is really not that bad. So what am I doing with all of this data? Well, I continue to remain bullish. So these are my open options positions for the moment. But what I'm really looking at right now is I'm going long certain positions because I already had money tucked away in the war chest from my sell of UPS and my sale of American Express, because I was, you got to expect market's going to pull back, and then you have money set aside, and then you kind of wait for the next push forward. And so I bought a bunch of advanced auto parts. I like them because the price was nice and cheap relative to where they generally trade. And I also like the fact that their price to earnings ratio, although high right now with respect to the S&P 500, its forward PE is very low, and its dividend yield is 3.46%, which way outpaces the 10-year. And the other reason why I like this is the dividend is 3.46%, but the dividend goes X on September 15th. Right now it's August 28th. So I would expect a spike in advanced auto parts to people trying to pile in to go ahead and quickly grab this dividend. So when that happens, I'm probably going to get a nice price for advanced auto parts when I sell it. And then the next place I'm going to look at is I sold those puts on Applied Materials. Applied Materials is a steal as far as I'm concerned, and I just as soon grab a whole bunch of this for 98 bucks if humanly possible. I plan on exiting the position at about $115. I think it will run up to about $100, $125. Whereas Morningstar has them rated at about $142 a share. I'm not too greedy. I'm happy to get out around 115 or so, and that would net me quite a good amount of money. If I look at advanced auto parts right now, Morningstar has their price that they're projected to hit, what they consider to be fair value, is $234, and it's currently sitting at $173. So these are very good companies for me to put my money in now while I believe the market is going to go up, and a place to store it and then when the market comes back down, I can sell these equities. Another one I'm going to be looking at is Tesla. Tesla just had a 3-for-1 split. It's currently sitting at $288. I'm looking to get into them right around $250. So if I see them come down to $250 sometime, I will be getting into Tesla. It may not happen, but I might just sell a $250 strike put just to do it if the premium becomes attractive to me. Right now, I didn't really care for the premiums on Tesla, or I would have a put already sold on them. When I look at their premiums, and I like to sell my puts as short duration, and if I do a $250 strike, remember this obligates me to buy 100 shares of Tesla for $250 a piece by the expiration date of the 16th of September. And if I even move it even closer to the 2nd of September, I'm only going to get $42 out of this. And so this wasn't something that I saw as a risk reward ratio that I was willing to get into last week. So it's just one of these things that I'm just going to hold off on Tesla for now, but it is something that I am keeping an eye on. All right, folks. Well, that pretty much does it for the week. I still remain bullish, like I say. I'm going to be having a real close look at the payrolls report that comes out on Wednesday. I'm encouraged by last week's PMI read and PCE reads. They show that possibly that the Fed is not going to have to tighten the screws as hard as some people might have feared, or at least even as much as they projected in their very own minutes. I do think that the equity market's going to follow the bond market, and it's going to probably come back down again to like, well, I guess go back up in this case, go back up again to levels that it was probably at the middle of the day on Friday or something, and get there pretty soon. I didn't see much in the way of earnings this week that really interested me. I took a position in CrowdStrike just because I usually do, and I might even do Lululemon because that's just I do that too. It seems just I can't stop trying to gamble a little bit here and there when possible. But mostly what I've done, my strategy right now is just kind of go long into some undervalued equities. And that's going to do it for this week. So yeah, go ahead and like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.